Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, Managing Editor of Real Estate here at Momentum Media, the team that brings you the Smart Property Investment Show. And I'm joined by my indefatigable co-host,
Emilie, Lauer.
And she's nice to introduce herself because I still can't pronounce your name.
Yeah, so look, I'm originally from France and I moved to Australia in 2015, so about almost 9 to 10 years ago.
Yeah.
And I finally got my permanent residency a couple
Wow,
of
congratulations.
weeks. Thank
Yeah,
you.
We're celebrating on a podcast.
Yes.
What better place to celebrate on? And we are joined today by an amazing expert that's going to talk us through some predictions for 2025. I'm joined by the Knight Frank Chief Economist and report author of a recent report published by Knight Frank, Ben Burston. Welcome to the podcast, Ben.
Thank you, Liam. Pleasure to be here, and congratulations, Emilie, on your visa.
Thank you.
There's a lot going on, of course, and in the world of property as well. So before we get onto the results of the report, which I know Emilie and I read with great enthusiasm, can you give us a little bit of background of the report? What was the genesis of it? How long has the outlook horizon been going on for? What sparked interest in it?
Sure. We've been doing this report, or in varying forms, for I think 2019 was the first time we did it. We called it our Outlook report, but then after doing a few years under that title, we felt that was a bit generic, and so we changed the name, call it a Horizons, which encapsulates our intent to look over the horizon. We have a lot of research on different markets, different cities that are more specific in nature, whether that's Sydney office or Brisbane industrial, talking about current market conditions, but we wanted to do something that was more forward-looking, that used data but wasn't entirely driven by data, and that it was using the data to form our opinion on where the markets are headed. So it's a longer form report that we're doing each year, and in it we aim to give some high-level views on the outlook for property investment, and for the most part that's commercial, although the residential market does influence that, and increasingly, and perhaps something we can come on to, the markets are merging in some ways, but giving some views there going forward, which we think will be of interest, and November's the natural time to do it as people start to look ahead to the new year.
And of course, people are unwinding on the road to Christmas, and so there's less data coming out. Now, you mentioned something that I find quite interesting, which is you're looking at the data on the one hand, but you're also giving your opinions on the other. Is that to suggest that sometimes data is data, but because of your knowledge of the industry, sometimes you might say, well, we're not as optimistic as the data, or maybe the data's showing too much pessimism and we're more optimistic? How do you bring that opinion in?
So I think it's both, in the sense that for some issues they're not readily quantifiable. And so whereas, and I mentioned we've got a lot of other reports talking about the markets in depth, where we've got good information, but there are emerging issues, and the changing nature of the workplace is an example where we don't have a body of 20 years of data that's going to be able to give you a precise estimate on the behaviour change, because we hadn't seen the pandemic before, we haven't seen the behavioural reaction before. So in some cases the data isn't there, and then related to that, the world's always changing, and so you do have historic experience to draw on, and in some cases that really sets you up and can inform you quite well. But you've also got to be aware that while history doesn't repeat exactly, there are common threads running through it. What's the saying? It rhymes, but it doesn't repeat. So that's why we always have to sort of, I think inevitably, forecasting is part science, but there's a bit of art there as well in terms of forming your judgment based on how the world has changed, in addition to what the numbers exactly tell us about past experience.
Now the report is over 70 pages long, and it goes into details on the real estate, office, industrial, rent to build and retail sector. 70 pages, very long. So how many people work on this? How long does it take you to gather all this information and come to the conclusion of what's yet to come in 2025?
Yeah, you're right. It is a bit longer. It's a bit longer this year. And look, maybe there's more to talk about. I can't exactly explain why. We didn't necessarily set out with the objective that, right, this year we have to hit 70 pages. It's not how we look at it. We start thinking in, I suppose we're always thinking through the year, thinking ahead, what might we talk about? But we really start to put pen to paper, I suppose, in September. And that's led by me as chief economist and head of the research team, a couple of my senior colleagues, Tony McGough in Melbourne and Janelle Wilson in Brisbane. They help me with the drafting. And so between the three of us, we lead it from a research perspective, and then we also draw in other experts on issues that we're not experts on everything, much as we like to try. And so this year we have a contribution from Fred Fitzalan Howard, who's our data centre lead based in Singapore, and he knows more about data centres than we do. And given that that's very topical at the moment, given the air trunk transaction, but not only because of that, but also because we sense a groundswell of interest from property investors who are responding to the growth of AI, I suppose, which is a topic in its own right. So we thought we bring in an expert there, and similarly we bring in our ESG expert, Janine Cranston, who's contributed an opinion piece. So the bulk of the works is done by the research team, but we draw on particular experts depending on what is topical from year to year.
And it is fantastic that you rely on the opinion as well, because that's where the subtlety, that's where the nuance comes in. And I mean, how many times in the commercial real estate market, in the residential real estate market more broadly, has someone said, I reckon this is going to be a growth area? And I mean, I've done it before. It's like, oh, you're an idiot if you think that. And then 5 years later, you're like, oh, okay, there was something to it, because you're reading the nuances and you're reading the subtleties in the market, which might not be relatively clear to other people. Now, I'm going to throw you a very tough question, but what is the biggest takeaway from this year's report if you have to narrow it down into one takeaway?
No, I think that's this year. I think it's a relatively easy one in the sense that we think that it's a good time to buy for commercial property investors. We think that last year we sort of hinted that 2024 was going to be a better time to buy, but we were very cognizant at that time that valuations in most sectors were still dropping, and indeed that has continued. But as we predicted, we think that pricing has settled through the year, and so at this point, having seen a pretty significant downturn, which varies by sector and location, but broadly, it's certainly the most significant downturn since the financial crisis, and in some cases it's been more significant than that. But the flip side, I suppose, is that for investors looking ahead, that they're entering the market at a lower pricing level. A lot of that downside risk has been priced in, if you like. We've seen the drop in values, and so even if things don't recover as quickly as we might like, there's much less risk that's involved in getting into the market now. And so our broad position there is that investors are setting themselves up for future performance if they're looking to acquire commercial assets in 2025. And
to be clear, when we're discussing commercial assets, does that include like industrial and trades areas? So obviously there's going to be quite a growing area of demand there. What about for people that might be a little bit hesitant about the other facets of commercial real estate, say office spaces? Where does that outlook lay in 2025?
So I think this year, so what we've seen, so let me just rewind slightly. So we've seen a really significant downturn in office values. And so the impact of the pandemic was most significant on office markets. It was also significant in industrial, mostly in a more positive way, because it ramped up demand. And so while there was uncertainty, probably in the case of industrial, that was outweighed by the fact that a lot of third-party logistics providers and retailers, they wanted to scale up what they were doing. So there's more demand for space, whereas in offices it's been the reverse, and it's played out gradually. And so whereas we didn't see an immediate reaction from office occupiers in 2020 and 2021, over the past couple of years we have started to see that. And then on top of that, of course, we've had the impact of higher interest rates. So the combination of those factors, the uncertainty around occupancy, higher vacancy rates, plus the overlay of higher interest rates, that the combined impact has been less confidence and falling values in the office market. So to come back to your question though, having seen that the market adjust to those forces, we're now seeing the office markets start to stabilise, and it's not happening everywhere all at once. So Sydney's a bit stronger, for instance, but we now think that the outlook for the different sectors is a bit more even. But before we saw this adjustment, you would have thought, right, the change caused by the pandemic means that we're going to see more demand for industrial, less for offices. And so that would suggest that your strategic position in terms of what you're looking to buy, that would push you towards industrial and lead you to be more cautious with offices, right? So that's been the story. But now that we've seen the values adjust, then the outlook, we think, for the different sectors is more even. And so yes, I mean, so that was a long-winded way of coming back to your original question, that it would include offices within that, but it's probably a sector where people need to be more selective in terms of what they'd be acquiring.
Now, you mentioned that the report is looking at the different capital cities in Australia. So I'm interested, what are the main, similarities and differences in between each capital cities, and what will the commercial market will look like for each and one of them?
Yeah.
I mean, broadly, yeah.
Sure. There's a few different angles to that, but I'll pick two. So starting from an economic perspective, I think what we've seen is a period of the Australian economy has been pretty sluggish over the past couple of years. So we've seen, just as higher interest rates has impacted property values, it's also impacted consumers. We've seen a decline in real incomes, which has been, again, documented in the papers the last few days. The OECD's noting that we've seen this, a more significant decline in household disposable income. And so consumers have had less money to spend. So that has slowed the economy overall, but within that, we've seen that play out in different cities and states differently. So we've seen Western Australia and Queensland fare a bit better. So there, of course, Western Australia is buoyed by, we've had high commodity prices for the past few years. They're starting to come off now, but that has really helped the West Australian economy. Queensland, again, so we've seen quite strong population growth, and part of that's driven by international migration, of course, which is fairly well understood, but less well understood is the net interstate migration, and we tend to see, partly in response to high house prices in Sydney, and to a lesser extent in Melbourne, we see strong intrastate, if you like, migration towards Queensland. So southeast Queensland, not just Brisbane, is a strong growth area. So they've performed better. On the flip side, Melbourne hasn't been as strong. So over the preceding decade, if you like, from 2010 to 2020, Melbourne led the way in terms of population and employment growth. It had a tougher time through the pandemic, and probably in the aftermath of that, there's some fiscal challenges which the state government is facing, and that's creating perhaps some more significant headwinds there. So the growth isn't quite as strong. So there's differences then from an economic perspective, and that then does feed through to how property markets are performing. Now, that's most obvious probably in the case of offices. So dealing with retail and industrial, broadly similar nationally. You wouldn't call out particular cities as being hugely stronger or weaker there, but we do see the office and probably the residential markets as well as responding differently. So just as we've seen, the house price growth, for instance, is much stronger in Perth and Brisbane than it is in Melbourne and Sydney to some extent as well. That's true in the office market too. So we've had less of an impact. The changes I mentioned around the behaviour change from occupiers has not been as significant in those markets. The impact of the pandemic itself wasn't as significant. We haven't had as much new supply coming through. The vacancy rates haven't changed as much. And so all of that has meant that the performance of the office markets in those cities has been a little more resilient and a bit more challenged in Melbourne.
See, one thing I find quite interesting about that is when I think of the Melbourne market and the challenges that residential properties are having there, I boil it down to things like increasing land tax, which there's a fine line between a residential property being viable and not viable for an investor, and increasing supply, so you don't just have the supply constraints as well. I find it quite interesting that that is also extrapolated into the commercial market as well. Is that just because of challenging economic headwinds in Melbourne and Victoria more broadly?
Look, I think across the board we've got some challenges, the rising construction costs, higher funding costs, and uncertainty around weaker market conditions, which is more obvious in the case of Melbourne, but then also a bit more uncertainty around the outlook for the office market. So that's making developers a bit more hesitant, and so we're not seeing. And indeed, that's one of the points we make is that the pipeline is starting to thin out. Now these office developments are quite big, so it takes time for the pipeline to thin out. So. And we're sitting here in your offices here in North Sydney.
Beautiful
I just got
North
out.
Sydney.
Yeah, so look, I got out at the Victoria Cross station, and so we've just seen the metro arrive in Sydney, and associated with that development, we've seen these overstation developments, which has added new office supply. Now, all of that was many years in the making. So those decisions were made quite some time ago, before the pandemic, and so. That sort of, there's more of a lag there, so it takes time for the pipeline to thin out. But we are now seeing that, and so over the next few years, and we call out Brisbane and Sydney in particular. Now that we've come through in Sydney that wave of new supply, there isn't much over the next few years. There hasn't been much in Brisbane over the past couple of years. There's a bit more coming next year, but then beyond that, 2026, 27, I think there's nothing scheduled. So that's the slow motion process, if you like, of the market, adjusting the supply side, adjusting to that. So there are parallels there with residential. So it's very topical in the context, housing being such a critical economic and political and social issue, and we've become more aware than we ever wanted to be, perhaps, of the constraints around housing supply, one of which is the challenge of feasibility for developers. So it's often said that we have bottlenecks on the supply side, planning challenges, and it's true that we do, but even if we meet those, it still needs to be the case that developments need to be feasible, the achievable rental income that developers are able to secure over those it needs to cover them for the cost of finance, cost of construction, and at the moment, in most cases, it doesn't.
Now, that's fantastic. I'm going to put you to the test in just a second after an ad break with some of the pieces of advice given in the report. We'll be back in just a second. Liam Garman here, Emilie Lauer from the Smart Property Investment Show with Ben Burston, the Chief Economist at Knight Frank. Now, in your recent Outlook Horizon report, you gave 7 pieces of advice. No, you're not going to escape them. We're going to go through each piece of advice here. But it's okay. I'll actually give you a lead in, so you don't need to do it off the top of your head. So, I mean, these bits of feedback were incredibly important, I think, for people looking to invest in commercial property. And the first prediction that you've gone through in your findings is an upcoming growth, meaning it's the right time to buy now. Can you unpack that? Why are we predicting growth for 2025?
Well, we're predicting the start of a new cycle, so I'll just tweak that slightly. So we think that we're turning the corner now to growth. We're not saying that we're going to be growing in every single market, but we think that what we might describe as the core markets, the big cities, the deepest and most liquid, in particular, the Sydney office and industrial markets, we think we're returning to growth. We think that while some of the valuations, it is taken time for them to adjust. There hasn't been a lot of transactional activity there, and so we're careful to draw the distinction between some of the formal asset values might have a little bit further to drop actually over the next, say, let's call it 6 months. But we think that is in some ways sort of catching up for some of the bad news that we've already experienced, and we think that on the ground pricing has stabilised. We're starting to see more transactional activity. And as we look ahead, some of the uncertainties that have been with us for going on 3 years around inflation and interest rates, they're still there, but the type of uncertainty that we've got is a bit more tolerable now, in that a couple of years ago, we weren't sure how high inflation was going to go, how long it was going to stay at that level, how high interest rates were going to go. They were still rising. Indeed, November last year, we saw a further increase. So even this time last year, we were wondering if there was further to go there. But yeah, we've seen interest rates being cut overseas. Australia is going to be slower to get to that situation, but the uncertainty around interest rates is more around how long we'll stay at this level and when will we see cuts rather than concern that they could go significantly higher. So there's one positive sign. We've seen the listed REIT market.
You've already jumped onto prediction number 2, which is around interest rate cuts. You have forecasted that there will be cuts on the horizon, which will guide recovery in the market. When do you think? I mean, that's the logical question that one would ask. When do you think they're going to happen? Are you being a bit optimistic with it?
We're not calling out a particular month. I mean, we're as property analysts and advisors, we're not called on, if you like, to give sort of weekly and monthly predictions in the way that banks might be. So we say in the report we think it'll be in the first half of the year, which is giving us a bit of room there.
6 months is pretty good.
6 months is pretty good. So at the moment, look, the consensus forecast is that we'll get there by May. I mean, it could be in February, but probably the prospect of that is probably not quite as strong as it was a few weeks ago. But mood changes at the moment. It looks like we could get there in May. And the reason I say that is because the RBA minutes sort of suggested that they were looking to see 2 more inflation readings that were a bit lower. And so if we're going to get 2 and when I say a bit lower, I mean that show that the trimmed mean, just to get technical on that for a moment, but the core inflation measure as opposed to the headline, I think they're looking for that to be 0.7, not 0.8. And if that would then imply an annualised growth that brings us back within the target range. And if they're looking for 2 measures that show that 0.7, then that leads you to, if we saw one in January and we saw another one in March, then in April, then when the Q1 data comes out, then that would leave us well placed for a potential cut in May. But look, we shall have to wait and see. But again, I think from the perspective of a longer term property investor, the exact timing is probably less important than the direction, and the direction looks more favourable. It would be highly unusual if we got through this whole cycle with Australia completely divergent from what we're seeing overseas, which is we are of course now seeing the cuts coming through there. So I'm not sure if that's sufficient. I'm not being too definite there.
I think you've given yourself sufficient breathing room in case it comes, in case it's announced in July. I think 1 month it will be fine. There's a lot of breathing room there. Now the third prediction is around investor strategy and how investors are ready to invest, whether it's in the commercial or living sector, after having held off for the past 2 years. Can you take us one?
So I think the point we're making there is one of strategy there. So we're making we make the broad argument that at this time in the cycle we've seen a significant downturn. Past experience would suggest that we're then poised to start the next growth cycle. And the related point is that there's been much less activity in the market over the past couple of years for the reasons that we've outlined. A lot of buyers have thought that, look, they just want to sit back and wait and see. They're not prepared to make significant new investments because the macro situation was unclear. We hadn't seen valuations adjust, but now those 2 parts of the equation are sort of coming together. And in the meantime, investors have had a chance to reappraise their strategy, because we have seen a significant market adjustment. We've seen a change in behaviour playing out in the office markets. We've seen, we've also seen a tightening up of residential markets, and so of course that's leading to those changing trends and the strong growth in house prices that we mentioned, particularly in Brisbane and Perth. But we've also got a rental undersupply, and that's playing into the demand to get into living sectors, which is something I still think there's a bit of confusion out there as to what exactly that is. But that would be institutional, not just institutional, but private, but investment at scale in residential property, but it's effectively commercial property with a residential use. And so there's a lot of desire to get into that
what is commercial property with a residential use? What does that look like?
Well, it's otherwise known as build to rent.
Okay, of course.
So,
Yep.
look, it's something that I think, given the downturn that we've seen in other sectors and the relative stability we've seen in that in that asset class overseas, particularly in the US, but also in Japan, also in the UK. More recently, that's become a bigger part of the market, and so investors, both domestic and offshore investors, are looking at the overseas experience, and they're also looking at the current situation in Australia and the rental undersupply, and they're putting two and two together and thinking there's an opportunity there to both diversify their portfolio and access what tends to be a lower risk, strong income producing sector, but then also taking advantage of the cyclical opportunity in the market. And so that's another one. But because we haven't seen a lot of that in Australia, it is still we just, but both from a building perspective, from a bank lending perspective, we don't have sort of a framework around the sector that's as well established, and so it's taking time, I think, for people to get the confidence to come into that. So the point we're making there is that both, while we're seeing the adjustment play out in the traditional sectors, this period has also allowed people a bit more time to sort of take stock of their plans and form new plans to get into those living sectors. But having taken that time, we now think that we've been through this unusual period of a really low level of activity. So there's a pent up demand there to both to reposition portfolios and to enter new markets. And as confidence picks up, which we think is happening now and will continue to happen through the course of next year, we expect that to manifest itself in more activity and development.
Now, I've been hogging the questions. Emilie, we've got to split this up.
I'll take on the fourth prediction. So look, the fourth prediction is on offices, and we talked a little bit about offices earlier already. Now, something that was surprising on that fourth prediction was that there's a potential future supply shortages of offices, which, was surprising because, you would believe that there is enough offices around capital cities already.
Well, look, I would agree with you that there is enough office around, but what type of office is it? And I think what we're seeing is the change in the market, the change in tenant demand, the change in workplace behaviour is resulting in an accelerate. There's always been a desire to gradually, as time goes on, as in many things, you upgrade your iPhone every few years, you upgrade your office, but there's been even more desire to do that post-pandemic. And what that means is that there's the demand is disproportionately going towards better quality buildings with strong sustainability credentials in great locations that benefit from transport, and so that's where a lot of the demand is. And I would argue that while at the moment we have enough stock, if we look a few years ahead in Sydney and Brisbane in particular, there's less stock coming through. So we think that better end of the market will be undersupplied in a few years' time, even though there'll be a backlog of lower quality buildings that will find it hard to all achieve occupancy at the same time.
So should those lower quality offices just upgrade rather than, sit vacant?
Well, the short answer is it depends. It depends whether that's where they are, how easily that can be done. So in many cases, yes. But then, as ever, the owner just needs to, take stock of the tenant demand depending in that particular location. Make sure that the amenity offering of the building is appropriate to the target market, and in an environment where there's more competition, so yes, there is more vacancy, that is likely to mean that the best course of action probably is to upgrade, to sort of position assets for success. But then there'll be some cases in markets that are more oversupplied where that might not be the optimal strategy, in that it might be deemed for some assets that the amount that you'd have to spend to significantly upgrade won't necessarily be met, or at least you wouldn't be able to confidently predict that you'll get a vastly improved sort of outcome in terms of occupancy and a higher rent at the end of that process. And so if you're not confident about that, then that's where it's a more difficult equation.
Great. Let's go on to the fifth prediction, and this one is all about industrial property supply, and it's shadowing some growth over there. How will this drive rent performances in Australia?
So we've been through this period. So in contrast to what we've seen in offices, we've seen industrial rents really take off over the past few years. That we saw the pandemic result in this acceleration of demand from both our largest retailers and third-party logistics providers. They wanted to scale up. We saw an acceleration of the online penetration of retail, and so we saw probably a bringing forward of demand, if you like, and supply wasn't able to keep up with that, and so we saw really low vacancy in industrial markets in 2021 and 2022 in particular. Still very low in 2023, but we've started to see that stabilise now. And in 2024, we've seen actually vacancy rates picking up. And so the pace of rental growth is slowing. And as we look ahead to 2025, there's more supply coming. The economy is going to pick up, but it's still a bit sluggish. And so we think on the whole that the pace of rental growth will slow. It has slowed already, probably slow a little further next year. So that then means that in contrast with the recent experience where it's been every market has just been undersupplied. There just has not been industrial space. And in contrast with the remarks I just gave on the office sector, where we've seen this significant divergence between the best space and lower quality buildings in industrial space, the growth's been just across the board. But we think the consequence of the higher supply environment will mean that we will see more divergence. So it'll be the locations that are better connected, and industrial that's less about rail connections and public transport. It's probably more about the infrastructure connections, availability of zoned and serviced land. And to the extent that we're seeing significant additions to supply in places like Western Sydney, places like Kemps Creek in particular, then that will probably slow rental growth in those markets. But at the other end of the spectrum, you probably have some markets like South Sydney and the Inner East in Melbourne, where we don't have that supply coming through, where vacancy is lower, will remain lower, and so we'll see a bit more growth in those markets.
Yeah, so the location is
which probably
really
plays
key.
well then for private investors. So part of your audience will be for private investors rather than bigger institutions who are looking to build really develop or acquire really large assets. It'll probably be the smaller scale strata type offices in those more tightly held, industrial facilities in those more tightly held markets that have the potential to see a bit more growth at a time when we're seeing larger scale development at a quantum of that is sort of slowing the pace of growth.
Right. Well, the sixth prediction is around retail, and the report actually noted that the retail asset is actually forecasted to be the strongest of the decades.
Yeah.
So that's quite big. Do you want to unpack that for us?
Sure. Well, I think retail's had a tough time over the past, you could say almost a decade, maybe not quite. But look, since the middle part of the last decade, and indeed we call out 2015 as being the last time where we saw really strong investor confidence in retail, really high levels of transactional activity, all of the different asset classes performing quite well. And by that I mean the really big shopping centres to the smaller neighbourhood centres. Since then, or shortly after that time, so in the 2015 to 2020, if you like, what we started to see was less confidence in the retail market. We saw the growth of online retail, which just generated uncertainty. It wasn't so much that it resulted in immediate poor performance for retail centres. It just meant that the perception that we would see continued growth in line with the historic trend, that people didn't have the confidence that would continue because they weren't sure how fast we would see retail spending shift online. But we're now significantly on from that. And of course, the pandemic then saw that concern accelerated. And I think now people are looking a few years on and they're saying, well, yes, the share of online is rising, but it's not rising that quickly. And actually, the fact that we've had really strong population growth, the fact that we are not seeing new shopping centres develop, which comes back to that point. Developers haven't had the confidence to do it, and also in the context of such a tight residential market, it tends to be the case that if someone has a suitable parcel of land, it's more likely, which they rarely do in a big city location anyway, but were they to do so, it's more likely that they'd be looking at residential rather than retail.
It is such a funny thing to reflect on, because I'm thinking like, well, you haven't opened up any shopping centres for a while. I'm thinking like, when I was a kid, it felt like, they were coming online quite often. And like, or your local plaza would do a massive upgrade into a Westfield, and it became a thing and people wanted to visit it. And then now I can't think of anything for years.
So I grew up in Canberra, and that was a classic case of that, where as a growing city with a deliberately polycentric model in mind, where we would have different regions of the city, and each region of the city, there would be, government, a federal department, so significant base of white-collar employment there, and a shopping centre. And that was the growth model. But as you say, we just haven't seen that. I don't know. I mean, I'm sure I could be proven wrong that maybe there was one recently completed somewhere, but yes, we're certainly not seeing it to the extent that we were seeing it in the 70s, 80s and 90s. And having seen that slowdown in development, plus the population growth, plus the fact that, yes, retail spend has been challenged over the past couple of years, but centre performance has mostly been pretty resilient. So I think, we're looking ahead, and we think that a lot of investors are looking ahead as well, thinking, well, the retail spend environment can't get much worse. I mean, it's been really, we've seen this decline in disposable income. That can't last forever. And as we return to growth, that centre performance is likely to improve further. And so again, coming back to the point I made at the outset, even if we don't see this really quick recovery, I think people are looking at the current market thinking that, right, pricing is rebased. It's an opportune time to get in. And so we're seeing investors' response. So a lot of investors having not had the confidence to be in retail, and again, we call out perhaps since 2015 because it looks good on a chart in terms of that was the last time we saw a really high level of activity. But I do think that broadly that correlates with when we saw that shift in attitude and more concern over retail, and we think now, nearly a decade on, we're starting to see investors have a lot more confidence in the sector and be prepared to re-engage.
Great. Well, last but not least, the seventh prediction of the Australian Horizon Outlook report is about build to rent. And we touched a little bit on that before. And build to rent is becoming more and more popular here in Australia. And you said that it will be a critical year. So 2025 will be a critical year for build to rent. Do you want to tell us more about that?
So 2025 is a critical year, and indeed I would say that the events of this week have been critical in that regard. So we wrote that section on the report about a month ago, and at the time I was saying that there's a debate which was going to come to a head, and indeed it seems to be coming to a head this week, about the two bills that the government brought forward to Parliament. One is the Help to Buy legislation, and one is a change to the taxation arrangements that apply to build to rent, particularly for offshore investors, and that relates directly to what's called the MIT rate. And so that is effectively it's the withholding tax rate. It's effectively the tax rate that offshore investors would need to pay on investment into a build to rent development, and effectively that's the tax on the income and capital growth applying within that structure. And the managed investment trust is the typical structure that an offshore investor would use. So why do we care about that? I think we care about that because in an emerging sector like build to rent, domestic investors, both private and major institutions, we're not seeing well, it's unlikely that domestic investors alone are going to drive a lot of stock forward. It's more likely that some of the major players offshore, and there we're thinking of names like some of the Canadian names, Oxford Properties, for instance, some of the major European names, APG, they are more likely to be the first movers. And they've got experience in those offshore markets. They have experience of the sector, they're comfortable with it, and they're more likely then to partner with local developers. However, the uncertainty around that tax treatment, given that one side of politics has wanted to change it, the other hasn't, that's just caused a lot of uncertainty as to whether it would or not go ahead. But we've seen the announcement yesterday, that the Greens have agreed to wave through that legislation, and so that is then, of course, that's a positive step of the implementation. We have to see how that exactly will be implemented, but that will be a welcome sign for offshore investors. And so, if that gets bedded down, then that is likely to have more confidence in the sector and a faster growth therein. And so I certainly think it has the potential to make an important contribution. I mean, we all know there's no silver bullet in terms of fixing our housing supply issues, but I do think that has the potential to make a positive contribution there. And so that's the point that we're making, that there's a lot of pent-up demand from investors and developers who want to develop that product. That has been one of the barriers, and so to the extent that it has been is likely to be lifted, then certainly that's a positive step forward.
It's a great snapshot into the world of property investing, because all it takes is a week of legislative changes and a lot can change. We're going to go to a quick break, and when we're back, I'm going to put you to the test again on whether some of these predictions might change. We'll be back in just a second. It's Liam Garman here, Managing Editor of Real Estate at Momentum Media, the team that bring you the Smart Property Investment Show, with my co-host, Emilie, Lauer, and our guest today, Ben Burston, the Chief Economist at Knight Frank. Now, before the break, we went through 7 predictions of your recent Outlook Horizon report. Now, of course, we're not looking into a crystal ball. We don't have the crystal ball. So there might be things that are subject to change. In a snapshot, what might cause these predictions to potentially not fulfill themselves? What on the horizon might pop up that we haven't factored in that might mean that we're a little bit off course?
Sure. Well, there's probably any number of issues there. Look, I think broadly our positions there, are pretty robust. But as ever, a significant change in the economic climate does have the potential to change things. So, look, were we to see, I'll deal with the positive side of it first. I mean, were we to see a swifter decline in inflation, both in Australia and overseas, compared to the current expectation, and were we to see then that result in a quicker and more significant decline in interest rates, then that has the potential to move things on again more quickly. However, if the inflationary pressure sticks around, and there we're talking about more domestically driven inflation in services industries, if that hangs around for longer and we don't get interest rate cuts in the first half of next year, if they take longer to come through, if they're not as significant, then that probably slows the cyclical recovery, if you like. So I'd call that out from a macro perspective. Look, I think also the pace of population growth has been, given the market a pretty strong tailwind. We've got uncertainty at the moment around issues like, for instance, the cap on student visas. That has the potential to impact not only the living sectors, which I've talked about, and within that, the student accommodation market in particular, but it's also makes a pretty significant contribution to net migration overall. So that's potentially meaningful in terms of the demand outlook. Look, I think, again, on the positive side, in a market like offices, which has seen those higher vacancy rates, were we to see business confidence pick up a bit more quickly, again, potentially related to a stronger economic climate and a move to a lower interest rate environment. If we see business confidence picking up more quickly, we see more activity in the leasing market, then that could potentially accelerate what we're talking about in terms of that demand at the top end and that tightening for prime space and potentially stronger rent growth there.
It seems like a lot of this very
a lot
much
of things
just falls into the political domain, right? Which is out of everyone's reach, all the way from population growth. I mean, if you had a particular election result, if it was potentially framing the next federal election, that could tilt it one way. Even things like talking about a swift downward pressure on inflation. Global energy prices, how unpredictable that can be. I mean, we've seen no shortage of global conflict in the last 3 to 4 years, how unpredictable that can be. It's just out of everyone's hands. Tariffs from overseas.
The one thing I'd say, though, is that, yes, all of those things are potentially impactful, but the broad trend, I mean, commercial property tends to be less volatile. So all of those things that we've talked about would impact the degree of change, whether the upside or the downside. Obviously, the bad news slows us down, the good news pushes us on a bit faster. But it's hard to see something happening next year that would be as dramatic as what we saw in 2022. And by that I mean the huge change in interest rates. I mean, we're just not going to see even under a more a scenario where inflation persists and we have to have interest rates at this level for a bit longer. I suppose the worst outcome would be that we have to push interest rates up slightly more, which I don't think that's going to happen. But with a move of that magnitude would not be as market impactful as what happened in 2022 because we've already digested such a big move. And property tends to we go through the cycles are longer, and so the things that we're talking about mostly move the dial up or down slightly, but they're unlikely to sort of shift us back. Having seen a significant downturn, I think it's pretty unlikely that we see that perpetuating much further. And in contrast with other asset classes, which sort of can move up or down, and equities is the classic move up or down a bit more quickly. So I'd expect property. We've worn a lot of bad news, but look, I think there's better times ahead, even if it doesn't happen to everything all at once.
And that is the best place to end the podcast. Mate, thank you so much for joining us today. Thanks, it was greatly appreciated.
Pleasure, Liam and Emily. Thank you.
That was Knight Frank's chief economist and the author of their recent Outlook Horizon report, Ben Burston, and we'll be back at the same time in just 2 days with another Smart Property Investment Show podcast, and we'll be back then shortly. Bye-bye. Gosh, I butchered that outro. I'll re-record it later. Mate, thank you so much for that.
Super interesting. Thank
you.
All
right, thank you.
That was a pleasure.
Yeah, pleasure, mate. Thank you, Liam.
Thank you.
I might actually do that one right now, so I don't forget. And that is all we have time for today on the Smart Property Investment Show, and we'll be back in just 2 more days. Until then, bye-bye. Done.
All right.
Easier. Mate, thank you. It was a pleasure. That was good. Hopefully I think we stuck to the script, didn't go off topic too much.
I think you did. Well, if anyone did, it was probably me crapping on, but seemed to go well.
Oh, that was great.
Yeah.
Do you ever get over it? Do you ever get tired of the...
No, well, not these. You do. We do some of these ourselves, but we don't do enough that it'll ever get sort of... I'll probably get tired of presenting the same sometimes. The same slides again and again. But we've got some new content to work with here. So
70 pages of it.
It's a lot, yeah. What's the next one?
Well, you're right. I mean, the designer, he gets hold of it and starts adding all these images.
And then it goes longer and longer and longer.
What is the next one you're working on?
Oh, look, I've probably had enough for now. But enough for report writing for this year. This is what I do most of this. Within the team, they do all those in the office. We'll probably just go back to doing our regular market stuff for a while, and then I'll probably do some articles which are more reflective, like in wait a few months, and then how is tracking? Are we on track? Or
an update. Well, hopefully with all the positivity, it stays on track.
Indeed. Yeah, absolutely,
mate. It was a pleasure. Thank you so much for that.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.